You probably think a cargo ship stuck thousands of miles away has nothing to do with your retirement account. But right now, global shipping chaos is quietly draining your mutual funds, slowing compound growth, and weakening the long-term wealth you thought was protected. And the worst part? Most investors have absolutely no idea it's happening. For years, people believed diversified mutual funds were the safest path to long-term wealth. Spread your money across hundreds of companies, stay invested, and let compound interest do the work. Simple. But the global economy has changed. Today, a single shipping bottleneck in one part of the world can trigger a chain reaction across entire industries. Delayed cargo ships, rising fuel prices, inventory shortages, higher insurance costs, all of it eventually reaches your portfolio. Even if you never see it, because modern investing is no longer isolated from global supply chains. Your wealth now travels through oceans, ports, factories, and geopolitical conflict zones before it ever reaches your retirement account. Imagine a cargo ship stuck at a major maritime choke point, thousands of containers delayed, electronics, raw materials, automotive parts, consumer goods. At first glance, this looks like a shipping problem. But it quickly becomes a corporate profit problem. Large multinational companies inside your mutual funds rely on global supply chains to operate efficiently. When shipments are delayed, manufacturing slows down, warehouses become overloaded, inventory costs increase, and suddenly companies start spending more money just to maintain normal operations. That extra spending reduces profit margins. Reduced profits mean weaker earnings reports, and weaker earnings eventually hit stock prices. So even though your mutual fund looks diversified, many of the companies inside it are connected to the exact same fragile global system. Most investors pay attention to visible fees, expense ratios, management fees, trading costs. But global shipping disruption creates something far more dangerous, a hidden friction tax. This tax doesn't appear on your investment statement, but it quietly drains performance anyway. Here's how. When shipping routes become unstable, freight costs surge, insurance premiums rise, fuel expenses explode, companies reroute cargo through longer paths. Every one of these problems increases operational costs for businesses. And businesses don't magically absorb those losses forever. Eventually, prices increase, profit margins shrink, dividends weaken, growth slows. That means the compound interest powering your retirement account starts losing momentum. Not because the market crashed, but because the global system became more expensive to operate. Diversification used to protect investors from localized disasters. If one company struggled, another sector could offset the damage. But globalization changed everything. Today, many companies depend on the same shipping lanes, the same suppliers, the same ports, and the same energy systems. That creates hidden correlation. So when supply chains break down, multiple sectors suffer simultaneously. Technology companies can't get semiconductors, retailers can't stock products, manufacturers face production delays, energy prices spike across industries. Suddenly, your diversified portfolio begins moving together under the pressure of global disruption. And investors are starting to realize something uncomfortable. Modern portfolios are deeply dependent on geopolitical stability, something no mutual fund brochure likes to talk about. Compound interest depends on one thing: consistent long-term growth. Even small disruptions become dangerous when repeated over years. If global supply chain instability continues, companies operate less efficiently, quarterly earnings become weaker, dividend growth slows, valuations become disconnected from old growth assumptions, and over decades, that compounds into massive differences in final wealth. Most people think compound growth only gets destroyed during market crashes, but slow economic friction can be just as damaging. Because it quietly reduces momentum year after year. Like driving with the parking brake slightly engaged, you still move forward, just much slower than expected. The modern economy is more interconnected than most investors realize. Your mutual funds are no longer protected from distant geopolitical shocks, shipping crises, or global bottlenecks. Because behind every stock chart, there are real factories, real cargo ships, real fuel costs, and real supply chains keeping the system alive. And when those systems slow down, your wealth slows down with them. The investors who survive long-term are not the ones ignoring these structural changes. They are the ones who understand how the hidden mechanics of the global economy quietly shape every dollar inside their portfolio. Stay tuned for more. And if you found this valuable, subscribe to the channel and hit the notification bell for more financial deep dives.